Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. The government shutdown in the U.S., combined with speculation on the Fed cutting interest rates, pushed the price of gold to roughly $4,000 an ounce today in New York trading. We heard from billionaire investor Ray Dalio. He said gold is certainly more of a safe haven than the U.S. dollar.
Gold is a very excellent diversifier of the portfolio. So if you were to look at, just from the strategic asset allocation mix perspective, you would probably have something like, as the optimal mix, something like 15% of your portfolio in gold, because of the fact that if you didn't even have a tactical, because it is the one asset that does very well when the typical parts of your portfolio go down. Ray
Dalio there speaking earlier to Bloomberg. Today, Goldman Sachs raised its price forecast for gold in December 2026 to $4,900. Now, that prior estimate was $4,300. For a closer look, I'm joined by Bill Adams. He is Senior VP, also the Chief Economist at Comerica Bank. Bill, appreciate you taking time to chat with me. Give me your take on what you see happening in the gold market right now.
I think markets are buoyant and they are searching for new diversifiers. And I think also markets are anticipating a pretty significant pivot to lower interest rates from the Fed. When interest rates fall, the opportunity cost of holding assets like gold that don't deliver a yield goes down. And so that often is a boost to the price of gold.
But we talk a lot about this debasement concern where the U.S. dollar is concerned. Do you share that concern, that worry over debasement?
I think about debasement in terms of inflation, right? That's measuring whether the dollar is maintaining its purchasing power. And I think inflation's likely to edge up a bit into the turn of the year, but probably stay around that 3% plus or minus zone by the CPI, maybe a bit less by the PCE index. And so that's inflation that's going to be frustrating for American consumers. It's certainly above the Fed's target, but we're not talking 5% inflation. We're definitely not talking 100% inflation. So this is not hyperinflation. This is merely inflation that is over target. You know, it's been over target for a while. So I think it's fair for markets to start becoming impatient for when inflation will get back to the Fed's target. But I don't think that there is a debasement crisis happening in the U.S. right now.
It's interesting you make that point. It was kind of mixed when it came to the day's Fed speak. Governor Stephen Miron was saying that he expects limited tariff impact on inflation, and that means that the Fed can keep easing. However, we heard from Neil Kashkari, and he is the head of the Minneapolis Fed, and he was warning that any drastic rate cuts would risk stoking prices. Does he have a point, Kashkari?
I think if the economy were growing robustly right now and the unemployment rate were still at 4% or under 4%, then I would be more worried about wage price pressures being sparked by rate cuts. But given that the unemployment rate was 4.3%, a lifetime ago in August, the last time we had a jobs report, and that it looks like the labor market from the spotty data that we have in hand probably softened or at least stayed soft in September. I think the risks of rate cuts pushing the U.S. into that sort of domestically driven inflation spiral seem less than they did 3 or 6 months ago.
So you mentioned the absence of the latest jobs data as a result of the government shutdown. There's a big question mark over whether we're going to see the CPI report on the 15th of the month. Give me a sense of how you are flying blind right now without government data.
We're not exactly flying blind. We certainly, I think it's more that we're playing with one hand, we're boxing with one hand tied behind your back, to choose your analogy. There are data sources for the U.S. economy, a variety of private sector price data and economic activity data, labor market data. They're not real substitutes for what we got from the government, but they are good complements to it. And so those data point to the economy being still in this low hire, low fire, low gear mode. And certainly the AI sector is going gangbusters. There's investment in software and computing equipment and data centers, in the electricity generation to fuel AI. But the rest of the economy is softer, and I think that probably is what's continuing to happen into early October. I think if we the longer we go without official data, the further we have walked with the blindfold on, and so the further we may be from where we think we are. But right now, a week into the shutdown, I think the uncertainty created by it is still fairly manageable.
So, Bill, today we had the survey from the New York Fed on consumer expectations, and there wasn't a lot of movement when it came to the outlook for inflation, or for that matter, the intention for household spending. I'm curious, given the fact that we're talking about a government shutdown, if this becomes protracted, how might the consumer be affected?
Most macroeconomic shops that do estimates of the impact of government shutdowns will tell you that it's a 0.1 to 0.2 percentage point drag on annualized real GDP growth in the quarter of the shutdown, when you have a shutdown, for every week that the government is shut down. So to put in concrete terms, the shutdown has lasted a week so far. That would shave off about 0.1% from your forecast of annualized GDP if there hadn't been a shutdown in the current quarter. And some of that activity will probably be made up after the shutdown ends and government employees get their salaries again, contractors get paid and catch up on delayed work, et cetera. So I think the shutdown is likely to translate into a softer fourth quarter of the year than we would have seen otherwise in terms of real GDP. But I think shutdowns, they don't, unless there's some new big shock to the economy, I don't think the shutdown would necessarily make the difference between an expansion or a contraction. I think this is another hiccup in the road, or a bump in the road, I guess I should say, on the way to an economy that's likely to regain traction in 2026, given lower interest rates and fiscal policy that's going to turn more expansionary.
So if your belief is that the economy will begin to recover given the benefit of lower rates, I'm curious about how you read the bond market right now, particularly at the longer end of the curve when we've got a 10-year at 4.12. Where do we go from here?
I think the bond market is pricing in significant cuts from the Fed over the next 18 months, and also pricing in the dollar retaining its purchasing power. To come back to where we started our conversation, financial markets, despite the run-up in gold, financial markets do not price a lot of direct concern about the creditworthiness of the federal government or the soundness of the dollar. You would not see the 10-year Treasury bond trading at a 4.1% yield if there were significant concerns about that priced into markets. So I think that's a sign of confidence in the outlook for the U.S. economy over the longer run.
So we know what the performance of the equity market has been lately. Many large cap tech stocks have surged by, in some cases, double digits. And this has happened in pretty quick succession. And there has been some concern expressed on the street that this could be a sign that valuations have become disconnected from underlying fundamentals. I know you're an economist, Bill, but I'm wondering what could happen if there is some corrective behavior in the equity market and how that may filter through to the economy's performance.
So if we see a stock market correction, I think a 10% correction without other economic shocks is probably something that the economy can take in stride. I think if there's a 20% sell-off and it's sustained, then we might see those more affluent consumers who've been driving consumer spending and growth of the domestic side of the economy for most of the last 2 years. They could start to pull back, and then we would see some softening in the parts of the economy that really have been in slow growth mode, but have been growing and supporting the demand for labor and kind of keeping the flywheel of the economy moving forward. So it's a risk, but I think that it's an area where, AI is this new technology. It looks like there will be applications of it that are very productive and profitable in the future and create a lot of new innovation and advances. We can't know precisely what they are today. And financial markets are pricing in a lot of optimism, pricing a lot of exuberance about it. Is that exuberance irrational, or is it just exuberance and confidence about the future? I think we'll have to wait and see. But the technology itself looks like it'll be transformational for at least sectors of the economy in years to come.
And I think we have to include banking and financial services. We heard from Jamie Dimon today, the head of JP Morgan Chase. He was saying the bank is spending $2 billion a year on developing AI technology. And currently, the technology is saving the bank around the same amount from that annual investment. And he went on to say that this is basically the tip of the iceberg. So if you track that, what that trajectory seems to be, they're going to get a lot more bang for the buck, so to speak. Would you say that banking and financial services is going to be one of the bigger beneficiaries of AI?
Financial services has been a technology industry for, I'd say, 10, 20 years now, and that trend continues. There's so much data in financial services that it is a really ripe ground for applications of technologies that process data more efficiently. And so I think financial services is going to be a big adopter of AI technology. I think real estate as well. That's another industry where technology has a large role. And I think we'll also see AI technology applied to the more labor-intensive sides of the economy, like healthcare, like food services, and I think that could help to enhance productivity in the sectors that have been more resistant to the penetration of technology over the last 10 and 20 years.
So I'm curious, Bill, as a chief economist, how are you using AI technology to help your forecasting?
Great question. I would say we are using it gingerly. We are looking at a lot of AI technologies, but we are being very careful in how we apply them so that we're not taking technology within the walls of our institution that would create risks for our customers, their accounts, or how our institutions run. So we're looking at a lot of opportunities here, but we're being very careful in our approach.
Bill, we'll leave it there. Always a pleasure. Bill Adams, Senior VP, also Chief Economist at Comerica Bank, joining us here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. The new leader of the ruling Liberal Democratic Party in Japan, Sanae Takaichi, has been a critic of interest rate hikes from the Bank of Japan. Well, now Takaichi is on track to become the country's next prime minister. So the question is whether BOJ Governor Ueda will face a tougher political environment and whether that will be at some point reflected in BOJ monetary policy. For a closer look, I'm joined by Bloomberg's Paul Jackson. Paul covers the economies and governments of both Japan and South Korea, and he joins us now from our studios in the Japanese capital. Paul, it's always a pleasure. Give me your sense of where things are right now, first in the political environment, before we get to BOJ policy.
Well, we have the election of Sanae Takaichi, as you mentioned, as leader of the ruling party. The ruling party's been in big trouble. It's been bleeding voters in recent national elections. It's needing a kind of rebranding, a restart. And they've chosen her. She's on the hawkish side diplomatically. On the economic side, she's very much in the Abenomics mold, which means easy money and flexible spending. So this is going to be a bit of a change from the administrations we've seen recently that have been kind of moving more to the central ground and looking at, paring back the stimulus, especially from Bank of Japan and keeping spending tight. But ultimately, the voters are saying, look, we've got inflation, we've got a cost of living crunch, and you're not doing enough.
Well, inflation, as you and I both know, you better than me, been well above the target of 2% for the Bank of Japan. And it appeared as though, at least for a while there, markets were anticipating a rate hike this month. Is that somewhat in doubt at this point?
Well, I think the governor of the Bank of Japan's in a very awkward spot now, because I think he'd been teeing things up, kind of lining up the ducks for a rate hike later this month. I mean, we've got plenty of positives. The economy's been growing the last 5 quarters, as you've mentioned. The inflation, I mean, we've been above target for 3.5 years. Those real wages have been going down most of that time. So in terms of orthodox policy, they should raise interest rates and get on with it. We've even had Scott Bessent saying the BOJ risks falling behind the curve. But if you've got a new prime minister coming in and she's very cautious about rate hikes, do you go ahead with that without some initial consultation with the government? We spoke with one of Takaichi's advisors earlier this week. That's Etsuro Honda, who's one of the architects of Abenomics. And he said that an October rate hike was too soon.
We like to think of governments and central banks as being independent of one another. Give me a sense of what that relationship is like in Japan.
Well, the Bank of Japan got its independence enshrined in law in the late 1990s, and it is independent to a certain degree. I think what we saw in the early part of Abenomics in 2013 was there was a joint accord between the government and the Bank of Japan issued, which both sides agreed to target certain goals. And that's where the 2% inflation target was put in writing for the Bank of Japan. Now, the accord says it's down to each side to decide how it carries on with its policy goals. So, you've got the independence of how you do it, but the target is pretty much agreed between the Bank of Japan and the government. So, yeah, it's independent, but it's to a certain degree.
So do we need to understand now that the BOJ is likely going to be forced to consider a lot more in the way of fiscal stimulus from this new government?
Well, I mean, I think it's going to be, first of all, it's going to be a tougher political environment for the Bank of Japan. It's had pretty much free rein under the previous couple of administrations. If we do have more fiscal spending or a loosening of fiscal policy under Takaichi, that's going to kind of add to the inflation, which, actually might mean the Bank of Japan has got to raise rates more quickly to kind of keep the inflation, under control. So it's going to be very interesting dynamics to see how things go, looking forward. But the thing that lies right in front of Ueda as he starts the second half of his term as governor is, can he go this month or not?
So since Takaichi's win, we have seen dramatic weakness in the Japanese currency. Right now, we're trading on the weak side of 152. And given the fact that Japan and the U.S. have yet to resolve their trade deal, this is still an open question. Anytime you have a weak currency, obviously it's going to favor the exporters. But at the same time, it contributes to an importing of inflation. Is there something that we need to discuss here as it relates to the currency where Takaichi's win is concerned?
Yeah, I mean, I think the currency could be the kind of deciding factor that makes the BOJ go later this month. It could be. Because if they don't move in October, we've got to wait until mid-December, till the next meeting. So you've got, 2 months of it's quite a long time if the currency is in that 150 range against the dollar. And remember that Japan has had to intervene multiple times in recent years to prop up the yen. And I would say that 160 mark is certainly territory that policymakers policymakers do not want to go in. And how's it going to look for Donald Trump? Well, it's going to feed into all his views that Japan is, weakening the currency to get some kind of favorable trade advantage. Now, that might not actually be the case, but is Donald Trump going to avoid saying that? Well, I think we know the answer to that one.
But at the same time, the equity market in Japan, the Nikkei at least, is at a record high. Does that give her anything that we can kind of call maybe goodwill?
I think, from the investor's point of view, they're thinking, hey, this probably means weaker yen, so that's good for exporter profits. So that helps stocks there. Also, the idea that there could be more spending, some kind of help to consumers, maybe in tax rebates or some kind of handout, so that means that they'll be spending more. They're going to spend more. Well, that's going to lead to more sales, more profits. So I think there's reasons there for the stocks to be going up. The question is whether that becomes a longer-term trend or whether we're just looking at the kind of initial knee-jerk reaction to her election.
Paul, we'll leave it there. It's always a pleasure. Thanks so very much. Bloomberg's Paul Jackson, he covers the economies and governments of Japan and South Korea, joining us here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.